So stocks finally had a down day today, as big of a down day as we have had or can have. So we'll talk today about, are we getting more? What are these signs of weakness that we might be getting on this intermediate run? Are we getting enough of them? How imminent may pullback be? How do we trade one if we don't? How do we trade a continuing bullish trend that's so mature in its length? We're also going to break down a sector today that's actually kind of breaking out of a sideways move to new highs that hasn't been doing too well lately. That's finally showing some signs of life. So we're going to talk about that and how to trade it. So let's go ahead and get started. Today is Wednesday, April the 17th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, and you can see, boy, is this the pullback? Right? I mean, we finally got a little bit of a down day today. In fact, that's probably the biggest move that we've had on the intraday basis since over here, March 22nd. I mean, we've had such little. Look how small the ranges have been. And today, I mean, it was pretty darn small too. We stayed pretty much within the range that we've had this week, for the most part of this week, after we jumped up on Friday to a new level there. But the result is, we still have a strong bullish intermediate posture. We still have a long-term market sentiment still bullish. The short-term sentiment's pulled back, and the near-term line's only, how many days here? We hit the low point right here. One, right? Let's see. Let me just make sure. Yeah. So 1, 2, 3, 4 days, and it's typically, 5 to 7 or 7 to 12. Excuse me. So we only got 4. So that's not the end of the world. But again, when you're looking for signs of this intermediate run maturity, this intermediate line getting above 50, when's it going to end? Right? You have to look for signs. Right? This is a sign. Dropping below extreme lows, near-term line dropping deep into the reversal zone, this divergent low point in the intermediate line. We've talked about all these. And now we have a bearish divergence of lower highs corresponding to higher highs on the index. That puts this low point, which is this, last week's lows, as our target for that divergence. And obviously, we're not anywhere close to that. And breaking below that would probably lead more towards a bearish posture, at least a weak bearish posture. And so, those are signs. I mean, now it doesn't look like it's going to happen tomorrow. I mean, it doesn't look like we're imminent anytime soon. The near-term line did not drop into the reversal zone today. The momentum line did not drop to an extreme today. So, we're not suggesting that things are going to really turn around right now, as of right now. But we're seeing more and more signs. That this 3-month now plus run that we've had on the intermediate line coming up above 50, which was already pretty long, when initially we weren't expecting it to be that long to begin with, right? We were expecting a little bit of a hiccup here in this area where we had to pull back here and then gotten the combination of bullish posture and bullish green line. So this has actually been a lot longer than probably was initially expected. But it can go longer, right? I mean, we saw one last year, at the beginning of that culminated at the beginning of last year, that went 5 months. So it went, that tax reform and the new year and all that really made, and of course because it went so long, the pullback was pretty darn steep. So it doesn't mean just because we're at 3 months, which is a pretty long run, and especially long considering, again, we were supposed to have a pullback first before we started this. Then we can get to, because at the beginning of these long-term runs, where the orange line rises up, your first intermediate run or more, or second, first and maybe the second, they tend to be longer. They tend to run towards 3 months, and then the last intermediate runs on a market sentiment rally tend to be shorter, right? 1 month, and this one was 2 months, almost 2 months, right? They tend to go skew more towards the 1 month time frame. Just like, your initial near-term rallies, when you start a market sentiment or intermediate run, your initial near-term rallies also tend to be longer. Well, you notice again here, we had a long one, and then we had a short one. And it was a divergence, and that's what should have led to this weakness, and we never got. And then you see we had, as it got going again, we had some long near-term rallies. And here's another longer one. And that's 7 days. That one was 7+ days, and now 4 days. So as we get, shorter runs, again, just a sign, another sign that we might be mature in this intermediate rally. Everything else, the Dow Jones Industrial Average, it looks very similar. In fact, today they haven't always been showing similar patterns, but today they're all pretty much the same. Remember, the Nasdaq never did drop below 50, so we're like a long time into this one big run has been one big near-term rally that is ending in this divergence that we have here. Intermediate confirmation signal with the oversold momentum line. So again, that's why I don't think we're going to tank tomorrow or the day after. But we're getting mature. You can see the Russell 2000 for once, as bearish as it looks here, because those ranges were so small. Its near-term line's not close. It's below 52, but it's not in the reversal zone. The momentum line's not at extremes, so the market sentiment line's not in the reverse, up here either, and it looks like it's starting to flatten out here. So we'll just kind of keep our eyes on that and see if that's a warning sign. And the moving average has flattened out, unlike what we've seen on all the others. So that's again kind of another sign of maturity in terms of how bullish we've been here, where we did get a little bit of a pause in the Russell, and we haven't got that pause anywhere else. Okay, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then hit that red subscribe button that pops out. Hit the thumbs up icon down below the video. That tells us that you like the video, you want us to do it again tomorrow. Really quick way to give us feedback. You can do right now while you're watching. Comment down below on anything that stood out to you. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Very easy way to subscribe. Click that link up there. Follow us on Twitter for more content like this in between videos from day to day. Join our Market Outlook community that we've created on Facebook. Let us know that you want us to keep doing these videos with 3 clicks. One, hit this heart right here that opens up today's Market Outlook tweet. Hit that like button. Number 2, hit this Facebook image. Takes you to today's Market Outlook Facebook post. You can like and share that. And then 3, like it here. And again, that gives you the points here in our community. To join our community, you have to click on this image to subscribe to our website. Then you can participate in our Market Outlook forum. There's a link to that. You can get to it right here as well by mousing over forums at the top and clicking on Market Outlook. There's a link right above the video. Of course, our classes are over here. We got our classes tomorrow. No classes on Friday or Saturday because of the holiday, the market holiday on Friday. We'll be back to, this is Brandon's class on Monday. Of course, to see our full calendar, hit this view more, or up here, click on events, and you see our full class calendar that we have. All right, back to the charts, and you can see the long-term chart, the range. Look at the range this week. Now, we got one more day left in the week, but look how small. That's what happens, right? You grind all the way up. You get really small ranges unless this is what happened that 5th month. Look at that. I mean, we were getting really small ranges. We were kind of petering out. We should have petered out right over here, but we were kind of petering out here, and then whammo, 4 weeks in a row straight to the upside, and the market's like, nah. Right? And so that's what we don't want to see happen here, right? And so we don't, that as awesome as that felt like during that 4-week run, it was, if you watched our videos there, it was, we talked about, take risk off the table, because as bullish as that was, that's not healthy. That's not normal. And really, for that matter, this kind of run without a healthy pullback is not normal either. It's a very long run. The Hakken-Yashi candles still look really bullish, but considering how small this week's range is, the next week's Hakken-Yashi candle has a really good chance of being one of those transition candles. So we want to keep our eyes on that heading into next week. We'll see how we finish this week, right? We might get a jump up higher this week and be able to start off really well next week. So we'll see what happens there. From a 3 green arrow standpoint, we got 1 red arrow. So that's usually the one we get first, is that lack of momentum. The MACD falls below its moving average. Remember, the stochastics has already fallen below its, well, it's been kind of trading around its moving average up and down. But the MACD is crossed below its moving average. That's what gives you the red arrow. The stochastics won't give you the red arrow until that blue line falls below 75. But when it does, it will be below its moving average, because the moving average is very extremely high. You can see, I mean, look past year, it doesn't get up and stay up this high for that long. So it's overbought, to say the least. But even with that, as you know, as big of an intraday move to the downside, you know, not, you know, big asterisk next to that, but you know, that all it did was get us down to the 8-day moving average. So, you know, grain of salt there. This is not that bearish of a move. You can see how you can just hover, and we've been hovering above that 8-day moving average for very, very long time. In fact, the 8-day moving average has stayed above the 17 for a very long time, and it can, right? It typically matches the run of the intermediate run on the market forecast. So that's kind of what it's matching so far here, but that's a long time, and don't be surprised if we don't grind any closer. We'll still probably test that 30-day moving average a time or two before we do actually get that intermediate pullback. All right, if you take a look at the intraday chart, again, you can kind of see an outside day. We gapped up, we came down, closed. I mentioned in class today, in our options inventory trading class, that, you know, I would have looked at today as a bullish engulfing pattern had we closed below these lows. Like, had we closed more down in this area, I would have felt like, okay, that's a pretty decent engulfing pattern. But we didn't get it, right? We didn't get that engulfing pattern. It stayed around the lows that we had so far this week on Monday as well as last Friday. So we're still up in this upper kind of level that we hit. We did hit a new 4-week high point, and so we are now 14 points. So again, that rubber band is stretched. So and now granted, it's going to, you know, tighten back up, not because we're pulling back down, but because this lower band, this lower thing's going to move up. But it's going to be a few days into next week before it does. So we'll see, you know, how much of a move. And remember also, this Hakunashi Open is also going to move up to probably in this area right here next week, and you can see how close that would be, and why it'd be, you know, why, you know, next week's got a really good chance of being that kind of transition candle that we get. So that's what the purple line. So in that dotted blue line is the midpoint, which will also act as support. As this moves up, so will the dotted line. I'm going to venture to guess that dotted line is going to move up into this area too. So the last week's low point, the Hakunashi Open, will be up a little bit higher, and this dotted line will probably move up into there and serve as a support on an intraday basis. Not very strong, but it will be a support nonetheless, like I said, on an intraday basis. You take a look at the volume and trading range today. The trading range was a little bit above average, right? So the average is very small relative to where it's been in the past. You'll see that in a second. But it's a little bit above average, and the volume at 58 million is a little bit below average. So you see it in context. So you see how low that ATR is relative to where it's been this year. So we were a little bit above that. But, you know, 4 points is a bearish range, so we didn't get that. And the volume was 50 some odd million, so that was also below the average, which is also very low right now. So again, 100 to 125 million would be bearish volume. So we're not getting that yet. So that's why I say, today's move was not a bearish move. It was a downward move, but it was just kind of, we have ups and downs. And the downs have been very, very weak, which is bullish as we continue to grind higher here. All right, now let's look at the volatility, and you can see the VIX is still at relatively low levels, right? We're still hovering around this 12 area here, which is right around the midpoint of the bullish range. We still haven't been able to get into this lower end and kind of stay here. You can see what that looks like. Like, for example, over here, when we started our bullish trend, we kind of got in here, and we were kind of hovering a little bit. We weren't really staying here. And we got the intermediate pullback, which is what we're expecting right now. And then, the bullish trend started. Then we traded up and down in this bullish territory and spent a lot of time in the lower half of it. That's typical. So we're not to that point yet, right? We're more to this point where we kind of dip our toe under, but without staying there. And then we get the intermediate pullback. And that's kind of what I'm expecting here eventually to get. And you can see, actually, the VIX today, long lower shadows. Long lower shadows on the VIX are rare. We typically don't get them. You get lots of times you get long upper shadows, You know, you can see all these up here, a lot of these long upper shadows, but you typically don't see long lower shadows. And you can see, like, for example, we had a little bit of one there, but they're rare to get the long lower shadows because the ranges are so small when we get this low in volatility. But we got one today, and that typically has been bullish for volatility. So that's something that we want to keep our eyes on as well. All right, so to summarize, the posture is still strongly bullish. There are some signs of weakness that are cropping up here, but nothing that screams like, you know, we're going to tank here and sell off sharply and start an intermediate pullback. So, but we are seeing some signs of weakness. So what, you know, we talked again in class today about keeping the pain trade, keeping away from a pain trade. Where the market can cause you pain depending on what it does. And obviously right now the pain trade for a lot of people is for stocks to go up. Probably because there's still a lot of cash on the sidelines from what I've been reading about, which means that people are missing out on a lot of this return. It's causing pain. So we talked about staying away from a pain trade, being too bullish or too bearish. And right now, it's okay to be bullish, but it's not okay to be too bullish, because then the pain trade will turn around and hit you. The market always seeks out the pain trade, whatever causes the most pain for you. So you know, right now, considering all these signs of weakness, you know, the market outlook is saying, you know, we might want to dial back the risk and not be too aggressively bullish until we get that intermediate pullback and more solid support level that we can bounce off of. Then we can increase our bullish risk at that point, as we expect new intermediate runs to start. So what do you think? Do you agree with that outlook? Do you disagree? There's a poll popping out right there, a link popping out right there. Click that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below on what you're seeing that would suggest otherwise from what we just talked about going through our routine. Alright, now let's take a look at what's driving the price action today. And you can see over here on the left, international stocks actually outperformed. Even international emerging market bonds did well, and long-term bonds in the U.S. Were an outperform. On the other end of the spectrum, small cap stocks, real estate did poorly. Crude oil and crude oil related industries did poorly. Here's mid-cap stocks, growth stocks, commodity stocks. Both types. Gold also down with the dollar kind of flat, and you can kind of see the performance here. International stocks did well. The dollar was flat today. It's been up this week. And then you see also on the other end of the spectrum, you have for the week now, this is agricultural commodities down, gold, and small caps. So it's kind of a odd combination to be leading the way to the downside, and small caps really has been the bulk of its losses, whereas today most of the gains in emerging markets came today. So when you look at what comes out on the calendar, of course you had the beige book out in the afternoon. That didn't really impact things too much. I want to take a look here at the international trade really quick and pull that up. And you can see how the year-over-year growth rates for both imports and exports are continuing to trend lower. In fact, imports now are down year-over-year. So that's not necessarily the most bullish sign from an economic standpoint. That's why our economic indicators continue to be pretty bearish. Very bearish. That's not a very bullish yielding environment. Of course, long-term bonds kind of flat down a little bit. But if you take a look at how they've been performing lately, the 10-year note has been rising. It's been rallying off of some extreme lows that we've talked about, you know, the clusters we got in the weekly charts. And so, you know, we weren't surprised that we're getting this kind of rally, but don't expect a bullish trend to come out of this. Not while we have this bearish, really bearish drop here. And also when we have no odds for rate hikes anytime soon. In fact, the furthest out we can go is next January, and there's not a single, not even 0.1% of odds of a rate hike going into next year. So that's what would make yields start to trend higher, and that's just not the case. So trade was the biggest thing coming out. Tomorrow we have a big basket of data before we have our holiday session on Friday. So we'll see if that ends up producing. Now, we did get a new estimate for GDP, and it'll be updated again tomorrow, but that's a pretty strong number, 2.4% from where we started, almost at 0%. So, you know, the market was expecting, And a lot of people were expecting that after the first quarter that GDP would really start to drop off. And, you can see the estimates are showing that it's probably not going to drop off heading into for this first quarter here of Q1, actually Q2. And of course, the other factor that would cause yields to go up would be a rising dollar, and that's not what we're getting either. You notice that our dollar is still flat. Moving average starting to roll over. We're bearish in intermediate posture here. We're not really going anywhere, but we're not going up. We haven't broken out yet to the upside, which would coincide probably with a jump up again and a new bullish trend in yields and the 10-year yield. Let me pull up the sectors here over on the left, and then the sector grid here. And you'll notice an interesting pattern that we see. Look how bearish healthcare was. Probably too bearish. I think we might have the low point now set in this healthcare sector. We'll see, right? We'll see. But that's a pretty big move in a short amount of time. I don't think we'll turn bullish anytime soon. But I think the sharp selling might be over with. You'll notice also that's not the only industry that's pink. You've got utilities and real estate now that have turned pink. Now they don't have red lines, so it doesn't look like we're turning bearish on those industries, and those are the interest rate sensitive industries. So again, kind of that they've suffered because of the bounce in yields, but this bounce in yields is not a new trend. So don't expect those two industries to underperform too much. But what's telling is, you've got some very strong industries. You've got some industries that are kind of, that are above moving averages, but just barely, kind of breaking out some flat trends. And then you got some bearish industries, and one really bearish. So when markets get really bullish, those correlations among these industries go down. They get really strong. I mean, when the markets get really bearish, everything goes down. But when they get really bullish, not everything goes up. And as you can see now, things had been, they've all been going up until just recently. Healthcare has been, kind of lagging behind. Financials have been kind of lagging behind. Industrials have been flat, but for the most part, they've all been relatively bullish. But that's not the case anymore. And another sign that, another one of those red flags that we might be getting closer to this end of this intermediate run. Alright, so for our trade idea of the day, I want to take a look at this financial sector. You can see that's actually kind of breaking out to 3-month highs, breaking out this little sideways trend that it's been in. Obviously, one of the biggest name stocks in that sector, Goldman Sachs, had its earnings earlier this week. In fact, let's take a look at the chart for Goldman Sachs here. Give it a second to load up. Alright, you can see, it's got a renewed bullish posture. There was the kind of breakout move it had last Friday ahead of the earnings. Then earnings came out. We fell down on Monday, and then since has bounced back up and closing above all these highs here after. So a good sign for the bank, and it's got a renewed bullish posture, dark green shading, a dark green line on the moving average because we're above a rising moving average. Obviously, we have 3 green arrows on the chart as well. 3 green arrows. We never did get the red arrows on the MACD or stochastics. Came close, but never did get those. You look at the 2-line versions of both these lines are both above their midpoints. Or moving average on the MACD is rising. And it's got room to go up. We closed back up above the 8-day moving average, which is also rising. You take a look at the Bollinger Bands for Goldman Sachs and the volume profile, and you see we're in the upper half of this Bollinger Bandwidth, and we're kind of breaking out of this volume node into this to this kind of low point of volume where we can move up higher towards this 228 level. And you got a pretty strong level of volume down here at 198 that can act as a support on any kind of pullback decline. You take a look at the DMI indicators, and you see that it's got we're above 25 on the positive. We're not below 20 yet on the negative, so we'll kind of keep our eyes on that. That would be more ideal, a little bit of a pullback after earnings. And then if you look at the long-term chart for Goldman Sachs, you can see we're closing up above the 200-day moving average there, and you can see a strong trend on the 50-day moving average, getting closer to that golden cross for the banks. You can see how we're breaking up above these highs from all these weeks here. So some good positive momentum here for the bank. Of course, that sets us up for a potential a credit spread, bullish spread here. We'll sell the 205, buy the 200. That gives us a little bit more credit depending upon where you get filled in. Let's say you get filled in $1.39. It's still more than $1.16. So if we say, you know what, let's just give it a little bit more, make sure it goes up a little bit more before we get in. That's the credit that we want. That gives us a good probability. We'll put a stop limit order there and set that in to get filled in as the market does move. And if it doesn't move, then we don't get filled in. Similar to that Occidental trade that hasn't been filled in yet either. Alright, so that wraps us up for tonight's video. Now I want to hear from you. Use that link that's popping out up there in the top right corner of your screen that goes to our forums. Open up any new thread, ask any questions or comments you have on anything we discussed in the video today or anything we didn't discuss. Remember, you can also reply to anybody else's thread as well and give your take on things. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment down below. Follow me on Twitter for more content. Join our Market Outlook community on Facebook as well as on marketscholars.com. Again, have a great rest of your night, everybody. We'll see you all tomorrow.